Good morning. It's Thursday, the 16th of May, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital, but in transit right now. Our top stories and themes for the day. India's rank in the MSCI index increases and why that will mean more flows into capital markets. How foreign institutional investors are most pessimistic on India in over a decade. Why oil prices could stay low this year thanks to soft global demand and mild weather in Europe. What should make more money, anonymous coding for global companies or selling your own brand of cars in global markets? How Indian companies are not paying sufficient attention to churning their boards and putting it off till the nth moment. And Singapore has a new musician rockstar prime minister.
This is a core report with Govindraj Ethiraj.
India goes up in the MSCI index. India's emerging market standing continues to grow even as emerging markets themselves as a category have now begun moving out and moving on after almost a decade of hibernation, as we pointed out in our conversation with ASK Wealth's Somnath Mukherjee on Tuesday, that's 14th of May. India's weight in the MSCI's Global Standard Index, which tracks emerging market stocks, has now risen to a record high, which means more funds potentially in billions of dollars could flow in. With this, India has further narrowed the gap with China on the index. While China's weightage will fall to 25% from 25.4%, India's will rise from 18.2 to 19%. Now, these changes announced on Wednesday will be effective May 31st, Reuters reported. Now, a lot of the rising prominence in emerging markets is thanks to the love it or hate it, but you can't ignore it mid-cap segment. Even as other emerging markets like China have underperformed, though they too have rebounded in the last few months. MSCI will add 13 Indian companies and delete 3 in the May review. Now, the main indices were volatile as election-related nervousness crept back into the markets, though not at the same levels as in previous weeks. The BSE Sensex ended down 118 points at 72,987 after some ups and downs during the day, while the NSE Nifty 50 ended at 22,200, down 17 points. Interestingly or not, as we referred to earlier, the broader markets held their gains, with the BSE mid-cap and the small-cap indices closing higher, somewhere between 0.6 and 0.9%. So the broader markets saved the day, so to speak. Now, several noteworthy folks have been arguing that domestic investors who are investing heavily in the market in the last few years will keep the market going at all times, despite also waves of selling by foreign institutional investors, which in earlier years, by the way, could have sent stocks crashing. For example, just in May, FIIs have sold over 17,000 crores worth of stock, but that's not really dented the markets, which have been hit more because of domestic investors grappling or searching to make sense of political signals. So, while domestic flows are strong, it's a classic markets mistake to build long-term views basis an average investor and mostly short-term behavior. Indian investors are pumping in funds and will continue to do, but there will be cycles where they will be selling either because of panic or some other need. At this point, you do need different classes of investors to pick up the slack and with different longer-term views on the market or to take up the market further. Now, this is something all institutional and veteran investors know and accept, but not everyone. FIIs are the most pessimistic in over a decade. So, on the subject of FII selling, data compiled by Bloomberg says that foreign investors are the most pessimistic in over a decade on Indian stocks. Net short positions, measured as the difference between the number of index futures contracts on which global funds are long to those on which they hold a short position, surged to around 213,000 contracts, according to data compiled by Bloomberg. Now, this gap is apparently the widest since data going back to 2012. Overseas investors have pulled out about $4 billion from local stocks since early April, reflecting a cautious outlook about the outcome of the election, says Bloomberg. Now, some of this obviously has to do with the expectation of lesser seats in parliament, despite a victory for the BJP, which is also priced into the market, as we've been referring to. Slightly lower turnout numbers at the elections is obviously adding to the nervousness. Now, let's get back to some stocks of Mahindra & Mahindra, which gained a 1.5%, which is not much, but it hit an all-time high of about 2,300 rupees on May 15th, a day before it was scheduled, or it is scheduled, to announce its January-March results, which is today. So far this year, Mahindra & Mahindra has gone up about 32%, outperforming the 2% rise in the benchmark Nifty 50 index. The reason we're talking about it now is because its stock price jump shows that the markets are still putting money into established companies, including in legacy businesses, even as they seek other opportunities. And another reminder, global markets are still strong. Global shares rose while the dollar retreated on Wednesday after a hot reading of US wholesale inflation data set a nervous tone for trading, according to Reuters. And if you haven't noticed it already, a frenzy in so-called meme stocks entered a third day, with shares in AMC and GameStop soaring by more than 25% in pre-market trading. Now, this is a phenomenon triggered by mostly day traders sitting at home, and thanks to the work from home phenomenon that we saw during COVID. And the last time this happened, movies were made on the phenomenon. And of course, people also lost their shirts, pants, and most of their clothing. So to get back to world markets, the MSCI All World Share Index is now trading at a record high, up about 0.15% on the day, which is on Wednesday. Global oil demand is softening. Oil prices are not responding to the classic risk premium factors like war or low-intensity warfare that we're seeing in various parts of the world. The reason is demand. The International Energy Agency, or IEA, has said the outlook for global oil demand growth this year continues to soften amidst an economic slowdown and mild weather in Europe. World fuel consumption will increase by 1.1 million barrels a day this year. Now, that's about 140,000 barrels less than what was expected a month ago, according to the Paris-based IEA, reducing its projections for the second month in a row, according to Bloomberg. This revised forecast reflects a first quarter demand contraction in rich countries with an upward revision to estimates for 2023. Now, all of this obviously links to economic growth somewhere, if not now, a little down the line. Poor industrial activity and another mild winter have sapped gas oil consumption this year, particularly in Europe, where a declining share of diesel cars in the fleet was already undercutting consumption, said the IEA. Oil prices are now trading a little below $83 a barrel, having fallen about 10% from this year's peak. Either way, consumption is on track to reach an annual record of about 103 million barrels a day, even with that lower growth forecast, according to the IEA. At this point, the IEA has made no changes to estimates for 2025, when it expects world oil demand to increase by 1.2 million barrels a day. So if you are trying to contrast with all the other increase in renewables or drop in fuel consumption because of, let's say, electric cars, that's not yet happening. Russia's oil exports are falling. Now, Russia's April exports of crude and petroleum products dropped to levels last seen in 2023 amidst Ukrainian drone attacks and planned output cuts, putting pressure on the nation's oil revenues, again, according to the International Energy Agency. Now, this is already impacting India's imports of crude oil, which stands at about 85% of total needs. Russia exported about 7.3 million barrels a day last month, down 6.4% from March, according to the IEA's report. Is writing software anonymously more lucrative than making cars, which everyone knows about? A few years ago, I was speaking to the CEO of an Indian software company on the sidelines of Software Industry Association NASSCOM's annual gathering in Mumbai. In that interview, he told me about this very interesting new project they were working on for a major global museum whose name you would know, wherein they were working on visitor data to create more insights and then solutions and approaches to build more long-term relationships with those visitors, among other things. Now, it sounded quite interesting to me, more so because Indian IT companies barely or rarely speak about the nuts and bolts of the projects they work on with global majors in any industry. It also sounded interesting because this was a museum and not some aging bank or telecom company revamping its internal systems. However, a few hours later, I got a panic call from the company's communications team saying the CEO had begged and pleaded not to use that reference to that museum because there were some strict non-disclosure agreements, which he obviously forgot about while speaking with me. I didn't see any point in making a point, so we deleted it. I was reminded of this story, however, when I read this insight from Business Standard yesterday, which said that Tata Motors reported a consolidated net profit of about 17,000 crores for the fourth quarter of 23-24, which was higher than Tata Consultancy Services' consolidated net earnings of 12,434. Now, this was the first time it was happening in many, many years. And this was also a 200% jump in bottom line for Tata Motors, while TCS grew 9%. Both are obviously Tata companies, and hence the contrast. Now, all of this might change in the very next quarter, but it's an interesting reversion to something more basic. Is there more money in making original products for which you enjoy brand value and franchise and, of course, market presence, or mostly anonymous coding for other companies, however big that might be? Well, the Indian IT industry story has mostly been one of anonymous service and quiet victories. While a Tata Motors, for instance, is a brand that is out there, for instance, in electric cars, where it now controls 80% of the market in India, and of course, its ownership of the iconic Jaguar and Land Rover brands. Conditions have conspired to make software coding more lucrative all these years, perhaps decades, including, of course, a weak rupee. But could that change in the next decade? I don't know the answer, but it's only logical that Indian IT companies could do better only if they had more products to roll out or to display. Put differently, when will India produce a Microsoft or an Adobe? Like I said, I don't know the answer. But the comparison between Tata Motors and TCS, which is, of course, once again the same group, did remind me of that question. Diamonds are not forever, once again. Now, this is an almost impossible to believe story on the face of it. A mining giant that's been associated with what is quite possibly the most prominent diamond brand in the world for over a century is looking to sell it off to focus on copper. Of course, the diamond industry is on the retreat thanks to falling prices and, of course, the well-known lab-grown or synthetic diamonds now substituting real ones in several markets, including India. Anglo American on Tuesday said it will spin off or sell its De Beers business, a brand it acquired in full in 2011 from the Oppenheimer family. The move is part of a wider restructuring to fend off a $43 billion approach or takeover from BHP Group. According to Bloomberg, the uncertainty over how a new-look De Beers may operate is spooking some of the industry's biggest players. Now, the entire supply chain knows exactly how an Anglo-backed De Beers works in a market it largely controls, and the prospect of a new owner could upend the way diamonds are sold. Diamonds are forever is, of course, the famous slogan that is associated with De Beers since 1947, who also conceptualized and propagated the concept of a wedding ring and a diamond ring at that in an engagement preceding a wedding or a marriage. Inflation hit consumers to come back to present times are apparently spending less, leaving diamond buyers holding too much stock. India's boards in their musical chairs. How free and effective are India's boards or boards of companies? Now, the straight of answer is barely so, as evidenced by the sheer number of friendlies packed into boards, particularly in family-run companies. Now, freedom and effectiveness in this case is defined by the presence of independent directors who are able to question or act as a buffer to owners who might play fast and loose on some issues, including regulation. Now, the experience is that when something has gone wrong, independent directors usually come out as having been silent spectators. The story today is about how hundreds of them are now rotating out and companies are not necessarily preparing for this. And when they are, it's usually to circulate, quite literally, a trusted family member, lawyer, or accountant. Some 36% of all independent directors in the Nifty 500 companies, representing 90% of the market capitalization of the entire Indian market, will churn in the next 18 months, says a study by Mumbai-based Institutional Investor Advisory Services. Now, one reason all this is happening is that the Companies Act 2013 introduced a maximum tenure for independent directors on the board of a company and grandfathering those appointed before 1st April 2014. IiAS says that investors expect companies to manage the board refresh in a staggered manner, balancing the need to refresh the boards while maintaining institutional memory. So, institutional memory is also important, so you don't want to chuck them out all at one time. So, in some cases, all of this is happening. But not always, because though most of corporate India has indeed planned their board refresh, there are some companies that have almost entirely shuffled their boards in a relatively short time period. And some of these names are, of course, well known and are in public domain. So I reached out to Hetal Dalal, President and Chief Operating Officer of IiAS, and I began by asking her how she was seeing this churn.
I think if you look at the Nifty 500 companies, right, just step back and see what is the regulation said. Regulation came in 2014, effectively saying that starting 2014, independent directors will have to rotate every 10 years, 2 terms of 5 years each. And what the regulation said is that they grandfather the previous 10 years. So if you were on the board for 20 years, you could be on the board for another 10 years, after which that you would have to be rotated out. So 2024 is really the cutoff at which now the grandfathering of the previous 10 years gets over, and therefore a lot of the independent directors will see churn. Now, several companies have actually managed this transition well. So they said that yes, 2024 is essentially the cutoff. So I'm going to start in 2020 or 2021 and slowly start sort of rotating the tenured independent directors and getting fresh ones in a staggered manner. So there is institutional memory which gets preserved. However, what we are seeing in some of the companies, the entire slate of independent directors are actually getting rotated out together in a span of, let's say, 2 months or 3 months. And therefore, that causes board disruptiveness. Essentially, the issue then becomes if I have 4 independent directors on the board and all 4 have been there for, let's say, 20 years or even 10 years, they have institutional memory, certain decisions have been taken, there were reasons and situations because of which and context for which certain decisions were taken. And now all 4 have left. I have a fresh bunch of 4 people which have now come in. So when I now have to review a decision which has been taken in the past, we're basically relying on the promoters to provide essentially a more concrete context to those decisions. And therefore, contribution to board deliberations will also be compromised or at least limited in the first few years until these new directors actually understand the business, right? So this disruption is what companies need to manage better. And what companies are essentially doing is running out the entire term. So if a director has been reappointed in, let's say, 2020, then the term will get over in 2025 if it's for a 5 years. So they're running out the entire term till 2025. So this entire rotation, you're going to see through 2024 and 2025, you're still going to see corporate India go through that particular rotation. But to put in context, the degree of the problem is not as large as it seems, right? Because the tenured independent directors today, after all the effort that corporate India has put in, account for essentially 5% of the total pool, but maybe 50, sort of 10% of the total independent director. So the degree of the problem is 10%. But it doesn't change the fact that when you drill it down company wise, right, there are certain companies where you would see a certain degree of disruptiveness, largely because all of them are or most of them are getting off the board in 1 year, in a short period of time. And you're going to see a completely fresh slate of independent directors coming. And that's an element of concern.
Right. So you're saying, in a way, this also reflects the board's inability or lack of desire to keep the board vibrant and churning all the time, as they should.
It's always tough, right? Even for NRCs. I mean, you have to balance board refreshment vis-a-vis stability also. Doing it, let's say, have, one director every year retire or at least exit the board and a new one coming, at least give you a certain degree of continuity. Not even if it's not one every year, it's one every 2 years also, it gives you a certain degree of continuity. I think some of the NRCs, and again, I say, if you look at the degree of the problem, right, some of the NRCs have indeed failed in being able to manage this transition properly. And now you have lost time, right? Now you don't have the time to stagger it anymore because the regulation has kicked in. And now there is basically, you just have to take that entire leap and say, I'm going to now refresh the slate of independent directors.
So the other allied issue is that many of them may not be doing this because in some ways they're only rotating people that are already known to them. So they know that it's going to run out in 10 years, but after all, I'm going to bring back my, let's say, a chartered accountant or someone who represents the law firm that I work with, who's also a familiar face, or it could be a family member, as your own study shows. And therefore, I'm not really making any major effort to do things right now.
Yeah, so we've seen this in pockets, right? In, let's say, a handful of companies, we have seen that there is a higher degree of focus on keeping the comfort zone tight. And therefore, if an independent director who's been on the board for 20 years is now 80 years old, is retiring automatically, or automatically or otherwise, but the NRC essentially narrows down on a family member of that particular independent director to replace. The other ways of replacing is that, let's say, the independent, it's a large group, and therefore one independent director who's been on the board for 20 years in a particular company will then get rotated into another company of the same group. So you can keep playing that musical chairs, right? And therefore your familiarity stays, but you have met the regulatory requirement. The third is, of course, to get ex-employees on the board. And this is, we are seeing increasingly in some of the companies where ex-employees who are loyal employees who've been worked with the group for maybe 20 odd years are now coming back after they are in an executive capacity as independent directors, while being associated with the group either as an advisor or through, on the board of unlisted companies or sort of working with the family in the family office. So this entire regulation which says that there should be a cooling period needs to be more tightly defined, right? In terms of saying that there has to be a complete disassociation between the individual and the promoter group and the group of companies. And of course, we are seeing another interesting trend in a handful of companies where a particular law firm has had a lot of its partners be on the board of a particular company for a very long period of time, right? So let's say it's from 1997 or 2005, you have like a law firm whose partners will rotate. So technically it is a different individual, but it is still a representation of the same law firm. We see that for CA firms as well, right? Where the partners will rotate, but the CA firm is basically being represented on the board. And that is a certain degree of, that's a different kind of familiarity, but it is still familiarity that you're trying to gun for rather than looking at, a fresh pair of eyes kind of a view.
As investors and institutional investors who you represent, I mean, apart from making people aware of this, which I guess is the first step, what else will or could investors be doing?
So I think investors need to start calling this out. And when these sort of appointments come to shareholders, investors need to sort of start giving pushback. I think the other thing investors need to do beyond giving pushback to the appointments or the reappointments is also start pushing back on the reappointments of NRC members. Clearly, if they're, looking at ways of maintaining the status quo or maintaining the comfort zone, the NRC is failing in trying to create a board which provides a comprehensive set of skills that the company needs. Boards are finally strategic, right? I mean, you have to look at where the company is, where the company is going, and what are the skills that the board needs to drive the company to where it needs to be. And therefore, it has to be a more objective assessment of skills and diversity rather than looking at familiarity and comfort zone. So we are seeing some of this. One is to push back, of course, on the independent directors' appointments or reappointment, but the other is also to push back on the NRCs. When they come up for reappointment, I think that's where the message becomes significantly stronger. And third, we will always advocate engaging with the company also, right? In terms of calling out some of these issues and saying that this is something that we don't like and we will continue not to support it.
Got it. Hetal, thank you so much for joining me.
Thank you very much, Govind, for having me on the show.
Singapore's rockstar musician Prime Minister. The island nation of Singapore has a new Prime Minister after 20 years. Lawrence Wong has become the city-state's first new Prime Minister, succeeding outgoing Prime Minister Lee Hsien Loong, who was also successor to and the son of Lee Kuan Yew, the founder of Singapore, who he also worked for 3 years in 2005. Lawrence Wong, that is, worked for Lee Hsien Loong as principal private secretary and civil servant, therefore, before joining politics in 2011. The 51-year-old Wong has an interesting personality, going by a Reuters profile of him, which refers to his going on TikTok to engage with citizens, including singing, playing guitar, and posting on issues like mental health. Colleagues describe Wong, who has held positions in the Ministry of Finance and will continue to hold that portfolio, as an able technocrat who embodies a generational shift in leadership and yet exemplifies continuity in a nation ruled by his People's Action Party since before independence in 1965. Wong is quite conservative and prefers incremental over radical change, a former colleague of his told Reuters. Though little is known of Wong's personality beyond the facts that he is a music fan and a dog lover, prompting one analyst to call for more details of his leadership plans. A National University of Singapore professor said that so far Wong has not laid out his political vision or why Singapore should support it, pointing to his guitar playing on social media. For me, he says, Singapore needs a prime minister right now, not a cover band. Well, that at least says something about Singapore's freedom of speech and the confidence among some to speak freely, if nothing else. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.